All right, hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks. And in today's video, I want to talk through some additional trades setting up using our reversal wave trader program. We have been putting out videos here this week, and I really appreciate the feedback and the questions that have been sent in. I want to cover some of those questions here today because you guys are asking great questions. If you have not had a chance to watch those videos, I highly recommend that you go back in the YouTube channel and review those. We do walk through some live trades that we're setting up. We walk through how to create a watch list, and we also talk through the different ways that you can utilize the reversal wave trader in different types of market conditions. And we're going to build on that here today. Before I get over to some new trades that are setting up, let's talk about the market big picture. We have had a big week this week. We had a lot of news out. Most recently, we had the Apple and Amazon earnings out after the close yesterday. Amazon, the market loved the numbers. Apple has sold off. We also had the jobs report out this morning, and the market really liked what it saw out of the jobs report as well. The way that we trade at NetPicks, we don't try to go in and try to interpret what the jobs report is trying to say. We're not going to go in and listen to the earnings conference call. We're going to focus strictly on what the market's reaction to the news is at that point. So what we're looking at is we've had some selling this week. We had a brief pullback middle of the week. We are now seeing the dip bought yet again, and it leaves us going into next week with a market that looks like it wants to continue grinding higher. If I take a look at the daily chart of SPY, you can see that we tried to break through the 20-period SMA and EMA. Those are the green lines on my daily chart. We tried to break through those here earlier in the week, but as has been the case for most of this year, if I zoom back out, you'll see that in a lot of cases when we try to break those levels, that is the trigger for the bulls to step in, buy the dip, and we're getting that again today. Certainly, we're seeing some of that summertime price action kicking in today as well. With the lower volume, summertime Fridays tend to favor that bullish outlook, or we tend to see those slow grinds to the upside, and that's what we've seen so far today. If we continue to move higher, the next area that would need to break either this afternoon or even into early next week is that magenta line on the chart. That's the 8-period EMA. It is currently sitting at, go ahead and grab that value here, sitting at 452.58. If that level breaks, we could see a quick push up to the high from last week back at 459.44. Those are the levels to watch here going into early next week. And then, of course, on the downside, if we try to make another attempt lower, I'm still looking at the 50-period SMA and EMA. Those are the yellow lines on my chart, and those are currently sitting down at 440.70 and 439.75. The volume has been okay most of this week. Here today, we've only had 28 million shares trade. Again, typical summertime volume here. I fully expect as we get into the next couple of weeks, as school starts to kick in for a lot of people, normally markets start to pick up once school kicks in. You start to see vacation season wrap up. You start to see traders back to a normal schedule, and you start to see the volume pop. And I think that's going to be the next big test for this market. Now that we're pretty much past all the big heavy hitters releasing their earnings, we can get back to markets focused more so on the technicals versus just looking at earnings and the jobs report. If you take a look at the VIX back down below 15. Again, the level of complacency is near an extreme right now. There's no fear in this market. No one thinks the market can head lower. And if it does head lower, the assumption is the Fed is just going to jump in, cut rates, save the day, and everything's good to go. Problem that I have with this market is we still see a market that is completely loaded on one side. Everybody is bullish. Everybody's expecting the market to head higher. And in a lot of cases, historically, when you see that type of sentiment, when everybody is leaning one direction, the market will typically like to throw everybody a curveball. And I want to see if that ends up playing out over the next few weeks. Now, what does that mean for us in the near term? As we've talked about here so far this week, I don't care if the market moves up or down, does not matter to me. I just want to have two-way price action. The moves that I do not like as an active trader, I don't like one-way moves higher. I don't like one-way moves lower. I like the back and forth movement because that gives us better activity. It allows us to see more frequency, stay more active, and let's face it, that's what we all want, right, as active traders. Well, we have had a few opportunities here this week. We've talked about some live trades. We closed out of a trade on Google earlier this week. We booked a 200% return on some long puts on Google. It was an in and out trade very, very quickly. We were in and out in 24 hours. Always nice to see those trades. And then the one that we talked about on our 130-minute charts was on Roku. We put this one on a couple of days ago. Now, I wanted to show these two trades because the Google trade was using our active trader mode. It's a brand new approach that we're using with the Reversal Wave Trader program. It's utilizing the 60-minute chart to look for very short-term moves back and forth. We're not looking to hold positions for any length of time. We're looking to get in and out, in most cases, between 1 and 3 days. And here is that setup from earlier in the week. Okay, it came on Tuesday. We had our magenta colored dots here. We had our entry, we had our target, we had our stop. Everything was outlined for us. Came in, bought some long puts, specifically the 132 puts that expire here today. We came in looking for a move to the downside. That's exactly what we got. The very next day here on Wednesday, we came down and we hit the target. And look how accurate the system was in identifying that target. We hit that target and price immediately found support. That's why when that target's hit, there's no second guessing. We're going to take the trade off, book the profit, and move on to the next trade. We have not had a lot of follow through, specifically on the downside here this year. And when I get those moves, I want to take the profit as quickly as possible. And it ended up being a $302 profit, 235% return in and out overnight, fully risk-defying trade, right? Whatever we pay to buy that long put, in this case, $1.28, the $128 that I spent to buy the long put, that's the most I can lose in the trade if I was dead wrong. Really nice position to be in. The problem with this trade is it gave us one way of making money. Fortunately, the move happened quickly to the downside. If it didn't, if it wasn't a big enough move, if it took too long, we were going to be in trouble. We are totally dependent on the market moving in our direction. Long term, I know it's not always going to be that kind. And that's why I want to diversify. I want to diversify with the markets that I trade. I want to diversify with the time frames that I'm looking at. I also want to diversify with the types of options trades that I'm looking at. So the second trade that we took here this week was based off of the 130-minute chart, and this is our swing trader mode. This typically is looking for a holding time anywhere from 3 to 20 days. That's very typical for us. I also utilize a different strategy, a much more forgiving strategy. And what we talked about doing is selling an out-of-the-money call spread. All that meant was I was selling two options at the same time. I was looking for either a period of consolidation or a reversal to the downside. And the whole thought process behind the trade is looking at the 130-minute chart here earlier this week. Look at how we had those 6 yellow bars on the pulse indicator. That pulse indicator helps us determine whether the market is overbought or oversold. When it plots yellow, it's telling us that price is between a 1 and a 2 standard deviation move on the upside. It doesn't mean price can't move higher. It just means it's not statistically probable. Only 13.6% of all occurrences fall outside of that range on the upside. In a lot of cases, when you see this type of a pattern, we're looking for at least 3 out of the past 5 bars plotting yellow. When we see that, it'll typically lead to either a period of consolidation or a reversal in the other direction. Well, lo and behold, what has happened? We had those yellow bars. It wasn't an immediate reversal, but I didn't need it to be, right? I just needed it to either move sideways or move to the downside at some point, and you can see that's exactly what played out. Now, the trade that we put on specifically, let me go back over to the trade page here, and on Roku, we went out to the August 18 options. Those are the ones that are down to 14 days left to expiration, and we went ahead and we sold the 95-97 call spread. Again, don't get intimidated by this trade. If you're brand new to trading spreads, maybe you're brand new to trading options altogether. All we're doing here is trading two options at the same time. The key here is that 95 strike. I need the stock price to stay below 95. I don't care if it moves up, down, or sideways. As long as it stays below 95, I'm okay. I'm also buying the 97 call to define my risk, just in case we're wrong and the stock continues to move to the upside. We just said it wasn't statistically probable, but it's possible. And if that happens, by buying that 97 call, that defines my risk. It limits the damage on a losing trade. We opened this trade here earlier in the week. We opened it for 65 cents. We collected $65 per spread, and it tied up $135 of our capital per spread. That's our max risk on the trade. You can certainly take the trade with multiple contracts or multiple spreads. You can take it with 10 spreads, and you're still talking about less than $1,400 of risk. Very reasonable to either keep the position sizes very small or ramp it up, just depending on how much capital you are trading with. The ideal scenario, on this trade is we made money the fastest if the stock moved lower. Again, I didn't need it to move lower, but if it did, I was going to make money the fastest. I also had time decay working in my favor, and I had volatility decreasing. If we had any type of volatility contraction, that was going to help me. Those are the 5 ways that I had of making money on the trade. Well, we did get a move to the downside. The market didn't crash. It wasn't a huge move lower, but again, we didn't need it to be. By collecting to 65 cents, that was my max profit on the trade. Okay, that's the most I could have made, but the only problem with that is to make that entire profit, I would have to hold all the way up to expiration. I don't like to do that. I would much rather close the trade out early, take my partial profit, and free up the capital for the next trade. The reason for that is we know over time, as you get closer to expiration, options become more sensitive to changes in stock price. It's known as the gamma risk. If I can close a trade out in advance of expiration, that's ideal. That way I don't have a trade that hits a really nice profit for me and then it turns around and goes back into a losing position. I'd rather take the trade off early. And what we like to do with these trades is we like to target 50% of the max profit. The max profit is whatever we collect to open up the trade. In this case, 65 cents. I was looking to close it out for around 32 cents. And that level was hit this morning. We ended up closing the trade out for 32 cents. It gave me a $35 profit per spread, which you're looking at that saying, wait a second, that's a $35 profit. Doesn't seem like anything significant. Well, that's a 26% return because I only tied up on this trade $135 of capital to begin with. It was a very low cost trade. I didn't have the home run profit potential that I had on Google, but in exchange, I had a trade that was much more forgiving. I had 5 ways of making money on the Roku trade versus only having 1 way of making money on Google. I'm not sitting here trying to give an argument for one or the other. My argument is let's use both. Let's use a combination of strategies. Let's have the benefit of going for those larger winners on the long calls and long puts, knowing that they're not always going to work. We need more to go right in those cases. And then let's also take advantage of the higher probabilities of the credit spreads. When you start to use both, now you get the best of both worlds. Now we're taking the full flexibility that options offer, and we can react to different types of markets. We're going to see more consistency. We're not just going to swing for the fences and go for the home runs on every trade. We're looking for more consistency over time. Where most traders struggle is they lose their discipline on those big swings in their equity curve, right? They have the couple of wins, they get aggressive, right? They get confident, they start to build their position sizes. They have a couple of losses, they give back all the gains, and then you just find yourself spinning your wheels. When you start to use a wide range of strategies, you're going to see a much better consistency in your results over time. All right, so that Roku trade did complete here this morning. That one was closed out. Now, what am I potentially looking at here for next week? I had a couple of questions on a few markets that people were looking at. One of them was oil on USO. This is the U.S. Oil Fund ETF. I had people ask, can we use this on commodities? Can I use it on oil? You can use this system on any market. We find that it works best on the most liquid stocks in ETFs. Could it work on the futures market? It could, in theory. I just don't have any type of test results to back it up. Could it work on crypto? It could. I just don't trade crypto personally. I don't have any results to back it up. I do know that it works really, really well on a wide range of individual stocks and ETFs. For me, I'm not using it on crude oil futures, but I know that USO is an ETF that gives me a direct correlation to the oil markets. So as you can see here on the 60-minute chart, this is our active trader mode. We did have a setup that triggered in yesterday. Our blue dots are the long trades. Anytime I see the blue dots, my middle series of blue dots, that was my entry point. I had my target up above, my stop down below. Everything was outlined for us. That trade triggered in yesterday, and it's just now hitting target as I'm recording this video. So really great trade there, and that's coming off of a trade. Here's a winning trade on the downside. This was a day trade on Wednesday. We had oil really active on Wednesday. That was a nice winning trade for us as well. So 2 winners in a row. Notice that the Wednesday trade was a day trade. We were in and out same session. In that trade yesterday, mid-morning, out of it here today. So in and out in 24 hours. These are going to be very active trades. This is not going to be an approach with the 60-minute chart where you can just come in once a day, check it in the morning, and then not check it till the following day. This is an approach where you've got to check it multiple times a day. It definitely takes more attention to the detail. Some people might love that. I do. Some people might say, my schedule just doesn't allow it. And that's fine. That's the beauty of having our swing trader mode as well, which we'll take a look at in just a moment, that 130-minute chart can be really great for those of you that have the busy schedule, because that approach does not take as much attention throughout the day. You get a lot of flexibility there. And then on USO going into next week, we do have a new short setting up. I have my magenta color dots down below that the trade hasn't triggered in. I have to wait for price to get down and touch that middle series of pink dots. If that happens, we'll go ahead and put on a bearish position, meaning we'll come in and buy some long puts. I don't care whether the market moves up or down. It does not matter to me. We talked about yesterday, we talked about getting a watch list in place. And I talked about how with the active trader mode, you don't need a list of 100 products. You don't need to run a scan of thousands of products. You just need a very tried and true list, names that historically have moved really well in both directions, names that have very good liquidity, especially in the weekly options. And I showed you a list of 10 products that we know are our go-to products. You can see there's a lot of tech stocks here, the index products, there's a financial name. You get a good mix, but in this case, I have to focus on the names that work really well, that move well over time. We can't just pull up that latest hot meme stock and hope that it works. I want to trade a product that I know the data backs it up long term, over months, over years. Bullish markets, bearish markets. I want to know that the system can perform in a wide range of conditions. Well, one of the names on the list was JPM, getting some exposure to the financial names. And you can take a look here on JP Morgan. Looks like a pretty messy looking chart, right? You can see my blue dots, the last long trade that was closed out, nice winner. Followed it up a couple days later, had a nice winner on the downside. With this 60-minute chart, I'm looking for very short-term swings. This is not going to be a buy and hold approach. This is going to be very active in both directions. And just here today, you can see I had my blue dots. These were setting up. These started to set up on Wednesday. You can see my middle series of blue dots. Those levels did not get hit until today. If I drag my data box over, my middle dots were at 157.09. My upper series of blue dots, those are my targets, 158.96. And then the stop down below at 155.05. Everything's outlined for me, and that's a bullish trade, giving me the green light to go ahead and buy a long call. Now, if I do that, let's go over to the trade page. I would go out to the August 11 options. Those expire next week. And ideally, my preference is if I can get slightly in the money, in this case, looking at the 155 calls, that's my desired option. It's going to cost a little bit more. If I went to the out of the money options, sure, they're going to be less expensive, but I need more to go right with an out of the money option. I'd rather pay up, get a higher quality option. In this case, looking at that 155 call, they're trading for around $2.90. Just under $290 per contract. If I bought that contract, it would give me a strict bullish position. I need the move to the upside into next week. And worst case scenario, whatever I pay for that option is the most I can lose on the trade. I can always close it out early if I need to next week. If my stop price is hit before expiration, I can always take it off and take a partial loss. So that would be a potential bullish trade on JP Morgan. If you're already in that trade, I'm just going to come in. I'm not going to sit there and stare at the screens all day long, but I'm going to definitely come in potentially this afternoon, when I have some time, come in, take a look, see what the market is doing. And one of the things I will do to shorten the amount of time required to take and manage these trades is I'll set some price alerts on my chart. If I know my target is up at 158.96, I'll set an alert to notify me when the stock is trading at or above, and I'm going to put the alert in. I'm going to go ahead and put it in at 158.75. I'm not going to get out until 158.96 is hit, but I'm going to put that alert in just in front of the target. That way, if I'm busy, if I'm out of the office, if I'm on the phone with a customer and that alert triggers, it gives me a heads up that, hey, it's time to get over to the chart. It's time to take a closer look, potentially take the trade off. That way I give myself some advance warning. In a fast-moving market, what I'd hate to have happen is to set an alert right on top of that target, have that level hit, but by the time I get over to my computer or over to my mobile platform, it's already moved away from that level. So I'd like to give myself some advance warning that we're getting close to that level. I'm also going to set an alert just in front of my stop. My stop's on at 155.05. So I want to be alerted when JPM is trading at or below, and we'll put it in at 155. We'll go ahead and put it in at 155. Again, putting it in just in front of that stop. So now I've essentially boxed that trade in. All right. So we cannot hit target or stop without being first notified through an alert. And I have those alerts sent to my phone as a text message. That way, if I am out and about, I get that alert to pop up. I know it's time to come in and manage the trade. I'm talking through it in detail, but this whole process here, when you're going in, taking a look at the charts, getting that position on, getting those alerts in place, it does not take very long. We're talking about a matter of a few minutes to come in, find the trades, get the orders placed, and then we move on. If we take a look at Microsoft is looking at a potential short setup. How do I know that? Well, I take a look at the far right edge of my chart. You can see my magenta color dots, the entry point's at 329.94. You can see it in my data box. And literally less than 10 seconds, I looked at this chart. I can see where my entry point's at. I don't need to sit there and put a bunch of different indicators or trend lines on. It's either a setup or it's not. And if it's a setup, right, I know exactly where the entry is at. I know where my target's at, my stop is at. All of that is outlined for me. Now, what I can do in this case is just like I did over on the JPM with a target and stop, I can go ahead and set an alert. So what I'll do here is, now that I know it is a valid setup, I'm going to go ahead and put an alert in place on Microsoft. I want to be alerted when the stock is trading at or below, and I'm going to go ahead and put this in. So now I have an alert in place just in case I get busy this afternoon, a headline breaks and the market starts to sell off. I get an alert to pop up on my phone that, hey, we're getting close to an entry, time to come in, get that order ready to go. So now in a matter of less than 60 seconds, I've identified the trade. I see where my entry point's at. I've gotten an alert in place. That's all I need to do. I move on with my day. You can go through a whole watch list of products very, very quickly. It does not take very much time to come in and do this. If you are one of those people that has the busy schedule, you can't come in and utilize active trader mode because you don't have the ability to check on the markets multiple times a day. We can definitely go over to the swing trader mode with the 130-minute chart, far less time sensitive, and still can get trades on. If I jump over to the 130-minute chart of eBay, now I can take a look at my pulse indicator down at the bottom. It's plotting yellow on the downside. Now it's telling us we're oversold. We have the last 5 bars plotting yellow, indicating prices between a 1 and a 2 standard deviation move on the downside. Doesn't mean price can't move lower, but it's at a point of interest now where only 13.6% of all occurrences fall outside of this range. You'll typically see either a period of consolidation or a bounce to the upside, right? So now out of this pattern, I can come over, put on more of a true swing trade. It's not going to be that active trader mode. This is going to be a trade that I plan on holding anywhere from 3 to 20 days. So if I jump over to the trade page, if the system is telling me that we're oversold and we're expecting a bounce on eBay, what I would do is come in, let's go out to the August 25th options, and let's just take a look at the 43.41 put spread. Let's just see if there's enough premium in those options. So all I would do is create this put spread where I'm selling the 43 put, I'm buying the 41 put. It's a neutral to bullish position. I want the stock to stay above 43. I don't care if it moves up, down, or sideways. All 3 directional moves are okay as long as price stays above 43. I also make money from time decay adding up and from volatility decreasing. Any combination of those 5 will work for me. Now, I moved the price to 50 cents. I don't want to get filled anywhere lower than 50 cents. If I got filled at 50 cents, I'd be risking 150 to make 50. Worst case scenario, I'm out $150 if the trade goes against me the entire time. I can always close it out early and take a partial loss if needed. Best case scenario, I make $50. But that's only if I hold all the way up to expiration and the trade goes in my favor the entire time. Like I mentioned earlier, we'd be targeting 50% of the max profit. So I'd be looking to close it out for around 25 cents. If this trade triggers in, it's a neutral bullish position. I know exactly how I'm going to manage it from start to finish. I can get the trade on. And then with this type of trade, I'm typically coming in, checking these positions once or twice a day. It's not going to be one of those situations where a few minutes here or there are going to make a big difference. This one here, because we're going to hold anywhere from 3 to 20 days, far less time sensitive. Again, you can utilize both the active trader mode or the swing trader mode. You can use one or the other. You have a ton of flexibility here. Doesn't matter if we end up zooming back up to all-time highs or if the market falls apart here over the next couple of months. There's things that we can do in both directions. If you are struggling with your trading, it's probably because of a few different things. It could be trading too big, using too big of a position size, or forcing one strategy to work and being too aggressive with your trading or not having that disciplined system in place. This allows you to trade a rule-based system in a wide range of market conditions. Every trade that we take is fully risk-defined. We know what our worst case scenario is up front, and this is going to be the game changer for so many people. I know it was for me years ago, just going to a complete rule-based system that blocks out all the noise and focuses strictly on price. Now, everything I showed you here today, the indicators, these are trades that we've taken this week, Right, these are trades that if you go back to the videos earlier in the week, we were talking about these trades in real time when they were triggering in. We've also talked about how to close them out. So everything that we talked about here this week is included with the Reversal Wave Trader program. The indicators, the training, the trade plans, how you take a trade, what do you look for in the options. We outline all of that in the training for you. And we are going to be releasing the Reversal Wave Trader program next week. We're going to have 2 webinars next week. We will be sending out a series of emails here over the weekend where you can sign up for those webinars. We'd love to have you join us. You can see the system in more detail. We'll walk through some additional trade examples. We'll be able to answer questions in real time. It will be a live webinar. So we'd love to have you join us. Love to have you join us with the Reversal Wave Trader program in the weeks and months to come. So if you have any questions on today's video, feel free to post a comment here on the video or reach out directly. Mike@netpicks.com is my email address. Otherwise, I am going to wrap this video up here. I'll be back with you guys here very soon with our next video.